Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man, and welcome to Fun with Annuities. Today we're going to talk about income riders. And income riders are attached benefits that you can choose to attach to a policy at the time of application that guarantee a lifetime income stream at a future date. And they're very, very popular out in the hinterlands of annuity sales right now. And they are a lot of times misrepresented and missold, and people think they're doing something that they're not. So I think it's very, very important to go over the details of income riders. Now, in my hands is what's called an income rider owner's manual, something that I've written. I've written 6 owner's manuals on specific types of annuities. And this isn't an annuity, but it's an important attachment. So I thought it was important to write a book on. It's about 55, 57 pages. I will ship it to you for free. And no obligation, no one will call, no one will show up at your doorstep, etc. But it's something that I think that if you're looking at annuities from the standpoint of for future income, then you need to look at this book. So go to theannuityman.com. You can sign up there. I'll ship it to you, or you can buy the Kindle version on Amazon. So with that being said, as with all products, I lead with the limitations, not the benefits. We're going to go over the benefits, but let's first go over the limitations of an income rider. The first one is there are annual fees for when you attach an income rider to a policy, and typically they're attached to either a fixed indexed annuity or a variable annuity. But anytime you attach an income rider, a guarantee for income in the future, there's fees for that, okay? And there's annual fees for the life of the policy. Until you die, there's going to be a fee taken out of the accumulation value, which is the investment side of the annuity, whether it's indexed or variable. If you attach an income rider to a policy and you start taking money out of that policy before you turn on the income stream, that income rider guarantee is going to be affected negatively. It's going to lower it. And there's a lot of limitations that you need to be aware of for taking money out when you buy an income rider. So before you even buy an income rider, make sure that you understand if you take money out, what would happen. The other limitation, and sometimes on variable annuities, and I don't sell variable annuities, by the way, but income riders are attached to variable annuities, is with some variable annuities, when you attach an income rider, sometimes they limit your investment choices. That happens. So you just have to understand the product and what you're buying. Most of the income riders that are out there, when you take the money out, the money is taxed LIFO, which is the IRS version for last in, first out, which in English means gains first. Okay? So it's a LIFO type payment, last in, first out. The other thing, and this is the negative, is, and we'll go through the details of this, but when you buy an income rider, if you visually draw a line down the blank sheet of paper, left-hand side is the accumulation value side, which is for variable annuity, the separate accounts, we call them mutual funds. And for index annuities, it's the index option. But that's one part of the calculation. That's the left-hand side of the ledger. Right-hand side of the ledger is the income riders, 2 separate calculations. And that's how 99% of them are shown. The right-hand side of the ledger, which could be a high percentage, 5, 6, 7, 8% growth on the income rider. And right there, I got to stop, because a lot of you going, hey, that sounds great, Stan. That's really high. What you have to understand is that percentage is monopoly money. It's not real money. It's not money you can access in a lump sum. You can't peel off the interest. It's used to calculate the first income amount. That's it, period. So there's not some actuary or an annuity company that's figured out how to take a 2%, 3% 10-year treasury and turn it into 8%. It is an income benefit. It's monopoly money that can only be used to calculate the first payment. And that's fine if your goal is future income and you're trying to get the highest contractual guarantee and the income rider came back as the highest contractual guarantee. But don't think it's interest. I have people call me all the time, Stan, I'm getting 8%. No, you're not. You have an 8% income rider that's monopoly money that only can be used to calculate the first income payment. Once you start the income payment, that phantom account, 8% stops. So it really goes back to, if it sounds too good to be true, it is every single time with annuities. And income riders fall into that category a lot of times on how they are presented. That income rider value cannot be transferred. So if you want to transfer to another annuity, that beautiful growth on that high percentage amount does not transfer. Just the accumulation value, that's a limitation. You can't get to it in a lump sum at all or peel off the interest, that income rider. So once again, use your common sense. If you're at the Bad Chicken Dinner seminar or in the office, the guy's pitching, and it sounds too good to be true, it is. Dig in, dig further, get the income rider owner's manual. But those are the limitations, which are fairly obvious if you have your realistic cap on. The benefits are good. Income riders solve for what I call income later. Deferred income annuities, QLACs, and income riders solve for income later, meaning I want the income stream to start at a future date. The good news about income riders is it's flexible. You can change the income start date one time after the policy is issued, and you don't have to turn on the income stream using the income rider. You can get all your money back out of the accumulation value and walk away. I guess a downside to that is most of the income riders, once you attach an income rider to a policy, most of the time, majority of the time, remember the line down the middle of the page, the income rider valuation is going to be much, much higher than the walkaway amount. But the flexibility is good. It can be used definitely for target date or income later planning. You can structure it joint life with your spouse, which is great, which means if you die, your Learjet hits the mountain, then your spouse gets the income stream uninterrupted, unchanged. It can be used inside of an IRA or outside of an IRA. IRA or non-qualified account, either one. And some income riders actually can be used as a death benefit, which is good. Not many, but some. And then some can also help with what's called confinement care, not long-term care. Long-term care is a health product, okay? A lot of agents confuse that. I don't think they know, to their credit benefit, give them a little leeway here. But in essence, with income riders, and I have a little rhyme that when you get sicker, you get your money back quicker. With some income riders, when you qualify for long-term care type coverage, can't do 2 of the 6 daily functions, they just enhance that income rider payout. So just remember, if someone's pitching you and says, hey, it's got long-term care, it's got all, no, it doesn't. If I get sicker, I get my money back quicker. Because remember, all income coming from any type of annuity, including an income rider, is return of principal plus interest. So what they're saying is we're just going to give your money back quicker. But if you can't qualify for traditional long-term care, which is still the best coverage, I don't sell it, but it's still the best coverage, and you're smoking 12 packs of cigarettes and drinking a bottle of Jack Daniels every day, then maybe one of these income riders with a confinement care benefit where you can get your money back quicker when you get sicker, maybe that's your only shot because it's a guaranteed issue product, okay? But in essence, the income rider solve for longevity risk. It pays you for the rest of your life, regardless of how long you live. It's a transfer of risk and a lifetime income stream. And remember, annuities are the only product on the planet that actually provide a lifetime income stream, period. That's the benefit proposition. It kind of kills me that the industry doesn't just pound on that. They're always trying to show you growth and market growth, and ours does this, and if the unicorns chase the butterflies, this return's going to happen. I tell you what, if I was czar for the day of the annuity industry, and I should be, staying the annuity man, czar of the annuity industry, maybe a future administration will appoint me that. Here would be the mantra: got guarantees? ? Remember the got milk? This is all about contractual guarantees. So that's what annuities do. Unfortunately, I don't think the industry goes in that direction a lot of time. They like selling the dream. I like selling reality. So, income riders, once again, let's go through it. It's attached benefit to the policy. You don't have to attach it to the policy, but most indexed annuities are pitched and sold with these attached benefits. A lot of the variable annuities are attached and sold with these attached income riders, which is fine because, if you need future income, at least you'll know what the contractual guarantee is of that income rider. And there's a lot of different types of income riders, especially on the variable side and also the index side. There's just not one. When I say income rider, there's 5 to 10 machinations of those. That's why I encourage you to get the income rider owner's manual, because I go through each one so that you fully understand the good and the bad of each one. So if someone says income rider, it's like someone saying the word annuity. It's not all-encompassing. Saying the word income rider is not all-encompassing. What I'm trying to do right now during this podcast is give you an overview of kind of what it is. In my opinion, income riders, like all annuities, are commodities, meaning that if you want an income later quote, you quote all income riders, as many as you can, to see who has the highest contractual guarantee. Because when you buy, in my opinion, if you're buying an income rider attached to an indexed or variable annuity, your sole decision for buying that should be on the income rider guarantee, not the indexed, not the variable side, not the hypothetical, theoretical, back-tested, hopeful return side, not the left-hand side of the ledger, which is the accumulation value side. You're basing it on the right-hand side of the ledger, which is the income rider side. Remember, the fees from the income rider come out of the investment side. So the fees from the right-hand side come out of the left-hand side. So hopefully I'm not showing paintings to blind people here. No offense to blind people. But what I'm saying is, if it sounds too good to be true, it is. Okay, so if someone's pitching, well, if the left-hand side outdoes the right-hand side, if the accumulation value outperforms the guaranteed interest rate or whatever that is on the income rider, it's not. In most cases, it's not. A lot of indexed annuities out there are structured so that the sales pitch is, if the index value goes up, then the income stream value increases as well. Put on your common sense hat. Sounds too good to be true, it is. What does the annuity company typically do? They will significantly lower the initial payment, to make up for any potential non-guaranteed increases of the income stream. Okay? So you already own the best inflation annuity on the planet. It's called Social Security, right? And Social Security kind of works like an income rider. It increases every year by a specific percentage. And then when you turn it on, that percentage goes away and you have a lifetime income stream, right? That's in essence an income rider. So it works the same way. So just be careful out there. A lot of the income rider presentations are very misleading, and they'll throw things in like, and you get an upfront bonus if you sign up today. Well, you have to believe me, there's no philanthropist at annuity companies. There's not CEOs that wake up in the morning and go, you know what, I want to give money away to the public. No. Anytime, without exception, an annuity carrier offers a benefit, they're taking something away within the policy. There's 100 pennies in the dollar. So I'm not saying bonuses are bad. Bonuses are contractual. So when you quote the annuity income rider, you quote it using the bonus, right? And if it comes out the highest contractual guarantee at the time you want to turn the income stream on in the future, then great. But what we found a lot of times is the products with the bonus, which is what I call candy for the stupid. I mean, if you think that you're getting free money, then you're the rube at the table, right? You're the person at the bad chicken dinner seminar they want to show up, that most agents want to show up. By the way, most agents are good agents. They're just some bad eggs like in every industry, right? But I see a lot of misinformation out there that comes to me. Hey, this guy said I can get a 10% bonus and get 8% of my money. Translation, you're getting a 10% bonus. That's something's being taken away within the policy, and the 8% income rider is monopoly money. So that's the reality of that pitch, even though when the pitch is not fully explained to people that trust people, it sounds great, right? So the other thing you have to be aware of with income riders, typically they're attached to these policies that have a longer surrender charge period. I'm going to guess it's between 7 to 10 years. It might be a little bit less, but most of the index annuity riders that I see people have purchased and didn't know what the heck they were getting are a 10-year chassis, 10-year surrender charge. The problem is once you get in it, it's really hard to get out. And when annuity companies attach an income rider to a policy, they're pretty much under the assumption that that income rider is going to be the highest value within the policy, meaning that you can't transfer it or cash in to get it. You have to access that income rider to access the highest amount, which is good business on the annuity carrier's part, because if you choose to access it, then the money stays there forever and they just pay you back your money with interest based on your life expectancy. So, you have to go into income rider purchases digging a little deeper into the details. And, if you want to see a specimen policy on the income rider, agents, including me, good agents will provide that. Okay. You can read exactly how they work. And variable annuity income riders differ a little bit from indexed annuity income riders. But at the end of the day, it's all about the contractual number. What I will tell you is do not buy an income rider based on a hypothetical. or a theoretical or a back tested. Buy income riders for what they will do, not what they might do. So in other words, if you do a 10-year deferred quote, hey, Stan, I'm 65, I want the income rider to start at age 75, then quote as many carriers as you can, which we do, and then show the highest contractual number at that 10-year time period. Not a hypothetical, never a hypothetical. Contractual, worst case scenario, Armageddon, and then base your decision on that. Okay? So I know I'm fire hosing you with a lot of information here, and I apologize because income riders can be difficult to understand if presented improperly. And I do, of all the books that I've written, the one that I get the most compliments on is the Income Rider book because, and the index one as well, but the Income Rider because it starts to get complicated. You know, immediate annuities, deferred income annuities, QLACs, qualified longevity annuity contracts, and also multi-year guarantee annuities, fixed rate annuities are very simplistic. Transfer risk, I love those products. But once you start getting into indexed annuities and income riders attached to indexed annuities and variable annuities, then it starts getting complicated. And that's when some of the sales pitches aren't as detailed as they should be, if that makes sense. So just remember that they are commodity products that you need to look at. You need to look at the fees. You need to understand the fees are going to be for the life of the policy, taken out of the accumulation value for the life of the policy. You have to understand that that great percentage rate that looks like Jimmy Carter's still in office is not real yield. It's monopoly money that's used to determine the first lifetime income payment, which is fine if you know that, right? But don't go in thinking you're getting 8% yield because you can't get to it. So I encourage you to get the book. I could spend 2 hours on a podcast, which I'm not going to do, explaining the good and the bad, etc. You can set these up joint life. You can set these up single life. You can put them in an IRA. You can put them in a non-IRA. There's just a lot to them, period. But so let's kind of close with the understanding that you should get the book, right? Nod your head. Close with the understanding that at theannuityman.blog, I go deeper into this and answer a lot of questions that on the annuityman.blog, I write a lot of posts, etc. But I also answer a lot of questions in audio questions. You can see the question that you want answered and then hit play and you can hear me and I'll answer it, which is kind of cool. And if you have one that I didn't answer, then shoot me a question and I'll put it up there. But let's go through some frequently asked questions. And I'm actually looking at the Income Annuity Owner's Manual right now as I'm doing this. And it might be repetitive on some of the things that I'm covering, but let's cover them quickly again with the understanding you're going to get the book and read it anyway. So here's the one. Why is the income rider percentage higher than CD percentages or MIGA percentages? The reason is because it's not real yield. It's a percentage that grows and compounds up until you take income during the deferral years. But that amount can only be used to calculate the first income stream payment. And once you start income, that high percentage that you fell in love with goes away, goes poof. Now, the fees from the rider is taken out of the accumulation value. So the income rider amount, which is that right-hand side of the ledger we were talking about, grows until you start taking income, period. So the other thing you have to remember, too, if it's growing by 8% or 7% during the deferral time period, then the fees are growing by that as well until you take the income stream. That's one that kind of flips people out when they run that math. But I'm a math person. I mean, annuities are math, period. Another one, can I peel off the interest rate from an income rider? No. Once again, it's monopoly money. You can't cash it in for the lump sum. You can't peel off interest. You can only, from the income rider, you can only use it to calculate income. And that's okay if you understand that in target date or income later, income is the goal. And you've looked at both income riders, deferred income annuities, and QLACs. You got to quote them all, depending on where you're at. If it's IRA money, you got to quote QLACs or DIAs. If it's non-IRA money, you got to quote income riders and DIAs every single time. One that I always get is I want to transfer my annuity to another annuity. And if there's an income rider attached to that annuity you're trying to transfer, most likely you're not going to be able to transfer. The receiving annuity company will not accept it, the transfer, because you're leaving that income rider benefit on the table because it will not transfer. And, it's good business practice. Annuity companies do that for a reason. They don't want you to transfer. They want you to move the money. And legally, companies will not take that money because when you transfer an annuity from one annuity to another via the IRS approved 1035, it has to mathematically be in your favor, you, the client, not the agent. Churning, twisting, whatever you want to call it, it's really frowned upon in the industry. And they put some governors in place to prevent it. And one of those is a side-by-side comparison. So if you own an annuity, you've owned it for a long time with an income rider, you're either going to have to grin and bear it and just cash it in and take the accumulation value, because you're not going to be able to transfer it in most cases to another annuity. And that's just, it is what it is. Another thing people ask, is the interest rate on an income rider compounded or simple interest? It depends on the income rider. Some are compound, some are simple interest. But at the end of the day, what we do is when we quote an income later quote, you've given us a year that you want to turn it on in the future, we'll just quote them all, simple, compound, and we'll just show you the highest. Sometimes it's the compound, sometimes it's the simple interest. It doesn't matter to us. We're just looking for the highest contractual guaranteed number. Okay. Also, too, people always want to know, does that 7, 8, 9%, whatever the high percentage they fell in love with, that monopoly money, does that continue once it's turned on the income stream? The answer is no. It does not. It goes away, and the annual fees that have been growing by that percentage lock in. But once again, there's so many different writers out there that you have to do your homework. My book is a good primer for that. But also at the end of the day, we need to talk about it and go through the good and the bad and make sure that you understand how it works, both limitations and benefits. The taxation of the income coming from the income rider is taxed last in, first out, gains first. So you don't have to attach an income rider when you buy an indexed or variable annuity, but most people do. I don't know if that's because agents want them to or they're looking for future income. I'm hoping it's the latter of the two. But with that being said, there's a lot to income riders, more than a 25 or 30-minute podcast can allow for, which is the reason I need to send you my book. You need to go to theannuityman.blog and dig more, and you need to get a quote to see it. And you can even dig further and get a specimen policy to see exactly what you are buying. And if you ever ask an agent for a specimen policy and they hesitate, that's not your agent. Okay, that's not your advisor. If you ever ask your agent for any information and they don't say, yeah, I'll get it to you without question, and they try to pivot, that's not your person. So remember, even with income riders, there's no urgency to buy one. You have to do your homework on your own terms and at your own pace and fully understand the good and the bad of the product and base your decision on the contractual guarantees of that product, period, and not some unicorn chasing the butterfly back-tested presentation that looks fantastic. A good friend of mine that's in the business and kind of one of the people I respect, she says that she's never seen an annuity proposal come true. That's interesting. A, because mathematically it's tough, but B, anyone can juice numbers. That's the reason we do the will do, not might do mantra. An annuity for what it will do, not what it might do. So I appreciate you listening. My name is Stan, the Annuity Man, and you've been listening to Fun with Annuities. See you next time. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.